What's up guys, Jake here. In today's video, we're going to talk about one of the most popular forms of retirement investing. Nearly 20% of Americans purchase these kinds of funds, and I'm talking about target date funds. Target date funds go by several different names. Sometimes they're called Lifecycle funds. Fidelity calls them their Fidelity Freedom Funds. Vanguard just calls them Target Retirement Funds, and Schwab calls them target date funds. However, I want you all to know that they're flaming hot garbage. Do not use these, do not buy these. Of course, I'm not a financial advisor, this is not financial advice, but in this video, I'm going to outline to you why I don't think these products and services are in your financial best interest. And especially in the last 20 years, all the major brokerage firms offer some form of target date funds. And if you do not specify what funds you want to be into for a 529, an IRA, or 401k, more and more people are just being defaulted into target date funds. So what is a target date fund? Well, basically the fund title will say a year. For example, 2050. So if you want to retire at age 60 in 2050, and today is 2020, then you have 30 years to participate in this target date fund, and you're investing over that time period with the expectation of being fully retired in the year 2050. And all these funds do the exact same thing. When you're younger, you're starting out more in US stocks, international stocks, holding a little bit of bonds, and there's this transition period where as you get older and closer to your target date for retirement, you switch from primarily equities to primarily bonds. Here's another way of looking at it with pie charts. Once again, these target date funds can have a mixture of small caps, large caps, international cash, government bonds, corporate bonds, but they all primarily do the exact same thing. And when you're younger, you're mostly in stocks, a little bit of bonds and cash. You transition at some point to being almost 50-50. And by the time you retire, you're mostly in bonds and cash, and you're only a little bit in stocks. So let's break down why these funds exist and why so many people use them. And we'll start with the pros. Number one, they're easy to understand. When you're younger, your portfolio will have more risk, more volatility. You're primarily in stocks, but as you grow older and you're closer to retirement, you transition to a more secure asset, bonds, so that your income is more predictable when you retire. Number two is you don't need to know anything. You don't need to understand stocks. You don't need to understand bonds. You don't need to understand what is the appropriate allocation for you. You just purchase the fund. It's a one-size-fits-all. You're good to go. Number three is that it feels like active management. People don't want to pay for active management because that costs more. However, when you buy a target date fund, it feels like something's happening. It feels like you're being auto-rebalanced, and some algorithm at least, is taking care of you and your retirement. And number four is people are risk averse the older they get. They do not like seeing loss. They're willing to sacrifice potential gains to avoid larger drops. People, lose sleep at night when their portfolio goes down by 5, 10, 15%. So by adding in bonds as you get closer to retirement, this prevents you from seeing larger red days. And number five, it just feels good to have layers of diversification. All the funds that these target date funds put you into are already well diversified. If you're in a total stock market index fund, you're in over 2,000 companies weighted by their market cap. You're already well diversified. But the target date funds are funds of funds. You get a little bit of the international index fund, small cap index fund, the bond index fund. So people like this super diversification being in a fund of funds. So let me now break down for you why these funds are bad. And the first one is higher fees. These target date funds often have higher funds than the funds that they're composed of. Why these large brokerage firms do this, I don't know. I'm guessing they make a lot of money off of these target date funds. But here is the Fidelity Freedom 2020 fund, and the expense ratio is 0.6%. I don't understand why that is so high. When you look at Fidelity's total market index fund, FSKAX, the expense ratio is 0.015. So this is like 30 times more expensive. When you go to Vanguard's website and you look at Vanguard's target retirement 2020 fund, expense ratio is 0.13. When you look at VT Sachs, their total stock market, it's 0.04. So the target date fund is 3 times more expensive. When you go to Schwab, the expense ratio for their Schwab Target 2020 Index Fund is 0.08%. But when you go to their total stock market index fund, it's 0.3. So once again, 2.5 times more expensive. Number 2 is if you put all of your money and all of your faith in a target date retirement, then you never learn anything about investing. If you can't tell me why you want to be 70% in stocks and 30% in bonds right now, then you shouldn't do it. You should understand why you want to be this percentage in bonds and this percentage in stocks right now based on what your financial needs and goals are. I know investing can be very intimidating and confusing, but I guarantee you, if you're investing for a 30-plus year period, you can take a couple afternoons, watch some YouTube videos, educate yourself, and then invest with confidence in specifically what is best for you. And reason number 3 is there is no customization. It's a one-size-fits-all when you buy a target date fund. And I like to joke that target date funds are the horoscopes of the investing world. You know, with horoscopes, everybody born in a certain month has the exact same future, the exact same fortune. Target date funds are the exact same thing. How can everybody retiring in the year 2050 have the exact same financial plan or same financial goals? These are all the factors that are completely ignored by target date funds. Your income and growth needs, what assets you own outside of your account, what is the allocation of all your investments, either in your 401k, your IRA, or your individual brokerage account. That should be factored in before you just generically buy a target date fund with a certain percentage of bonds and equities. Number 4 is huge, and that is your ability to deal with volatility. If you're comfortable seeing a 30% drop, then you can handle more equities if you're confident that it'll recover in the near term. Number 5 is tax minimization plan. You know, when you retire, you should be doing everything you can to minimize your tax burden in retirement if you're no longer earning income. And target date funds don't help you do this at all. Number 6 is your investing horizon. If you start investing at age 50, 10 years before you want to retire, your investing goals, your investing plan will be dramatically different than somebody who starts immediately at age 25 with their first job. So once again, target date funds completely ignore your individual goals, your individual needs, and it's a one-size-fits-all. But hands down, the worst thing about target date funds is they are too conservative with your money. And I can demonstrate this in several different ways. So let's look at Fidelity's Freedom Fund 2050. So this is the allocation today in 2021 if your goal is to retire in 29 years in 2050. So you're 54% domestic equities, so this is US stocks, 36% international stocks, 10% bonds, and 0% short-term funds. This would be cash. So at least you're not holding any cash, but you are in 10% bonds. And what I want you to realize is that if you're in 10% bonds today, if you are holding in a retirement account 10% of your money in bonds today, it's just going to sit there for 29 years. This wedge, this green wedge of 10%, is the exact same green wedge of 10% here. And this is terrible to be holding bonds for 29 years. So when you look at the 10-year Treasury nominal yields, this is how much money you're making on your government bonds. And I think when people were talking about what allocation in retirement accounts should be equities versus bonds, a lot of this theory was formed in the 1970s and 80s. When you bought government bonds, at one point you could get 15%. Why would you ever buy stocks when you were guaranteed 15% on your bonds? However, the last 40 years has not been good for the bond yields. And the amount of money, the percent APR you're earning on your bonds progressively goes down as the Fed keeps cutting interest rates. So currently in 2021, you're earning only about 1.1% on your government bonds. So a concern here is that there are some years where inflation beats what you're earning with your bonds in your retirement account. Anytime this red line gets above the blue line, and you're holding government bonds, inflation beat what you were earning on the bonds. Your bonds were not protecting you against inflation even. You were just net losing money when you think about the purchasing power of the dollar. So think about that wedge, that 10% that you have in your target date fund right now. And once again, it just sat there for 29 years, potentially only earning 1, 2, 3%. I think interest rates will go up a little bit on the 10-year Treasury notes, and you could be earning hopefully more than inflation, but I don't see it getting as good as it was in the 1970s or 80s. So holding 10% in this wedge for 29 years, you're just losing so much potential money on what you could have by retirement. The next factor to consider is that these funds have fixed percentages. Based on the year, the percentage is fixed, and there's a drawdown. There's a drawdown of equities to bonds. So when you look at this 54% of US stocks, over 29 years, it has to go down to the fixed percentage of 32%. What does that mean? That means you are always selling stocks to buy bonds. So it doesn't matter if the stock market is going up, if stocks are going to an all-time high. You're making money, but you're also losing money because you have to sell your stocks. Every year, a small percentage of your stocks is being sold to go to bonds. And I don't see anybody who would rationally approve of this. Oh no, my stocks are going up too much. I better sell them off. My investments are doing too well. I can't handle that. And the reason why is because your bonds performed so terrible. So when you own government bonds in a retirement account earning you 1.1%, this is a fixed percentage, 39%. So you have to sell off your stocks, which on average in the long run earn you 10% a year. And you have to sell those to buy bonds to maintain these fixed percentages. The secondary effect of this as well is that you sell your stocks when the stocks are down. If you study index fund investing, the best piece of advice I can give you is do not sell at a loss. Do not sell, especially in a retirement account. Do not sell when your stocks are down. Give them time to recover. Most recessions, most stock market crashes, you'll see it recover within 3 to 5 years. And if you're investing on a 20, 30, 40-year time horizon, you have time for it to recover. However, these target date funds will not let you do that. So if this percentage has to be 39 and this percentage has to be 32, when there is a temporary drop like the crash that occurred due to the 2020 pandemic, it doesn't care. It's gonna sell your stocks to buy bonds. Yes, there will be a momentary rebalancing, but it doesn't care that what the market is doing. Target date funds are incapable of considering current events or news or what the market is doing at all. It only does one thing. It slowly sells your stocks over time to buy more bonds. I honestly believe that index fund investing is for everyone. It's not that complicated. Just pick an S&P 500 index fund or a total stock market index fund and buy and hold. Do not pay attention to the market. Buy and hold. With dividends and capital gains reinvested in a retirement account, on average, over the long run, you can expect 10% a year. At a 10% return, your money doubles every 7.2 years. And with these target date funds, you give that up by diluting the performance of your stock portfolio by buying these government bonds, which are worthless. You will never outperform the market. So here, I can pull up an infinite number of charts for you guys. But this green is the Fidelity 2020 fund, the red is the Vanguard 2020 fund, the blue is the Schwab 2020 fund, and the black is the S&P 500. This is their performance over the last 5 years. So the Fidelity fund was up 14%, the Vanguard up 18%, the Schwab up 30%, and the S&P up 79%. Even with the huge dip, where the S&P 500 lost 30% in March of 2020, it still recovered. And all of these funds also saw a dip, and they didn't recover as well. So why do the large brokerage firms push these target date funds? Why are they the default for investors to put their money in if they don't choose anything else? And I honestly believe these target date funds exist to protect people from themselves. People are not good at timing the market, and when there's a newsworthy event, they panic. So when you think about this 33% drop or whatever it was last year, people panicked and they sold at the bottom. And you don't want to sell. You want to always hold and give it time to recover. But there are people who saw their investment portfolio going down and they panicked and they sold. They then they weren't believers in the recovery or the stimulus or whatever, and they refused to get back in. And maybe they waited until here to finally get back into the market, thus destroying their portfolio performance. So the big banks, the big brokerage firms, they don't want you actively investing your money because they're trying to protect you from yourselves. Target date funds dilute the performance of the market. There's less volatile swings. You have lower highs, but also higher lows in the stock chart movements. And I think this is very appealing because they want to retain you as customers. They don't want you getting frustrated with the down years. Think of the 2000 dot-com crash, the 2008 recession, this flash pandemic crash we had in 2020. They don't want you paying attention. They want you just to keep giving them money because they make money off of the expense ratios and the fees. But the truth is, you can earn way more money if you just buy a S&P or total stock market index fund, buy and hold, do not try and time the market, just keep buying and holding. So in the event that you're holding a target date fund or you know somebody who's in a target date fund, hopefully I demonstrated in this video why it's not in your financial best interest to stay invested in it. But of course, I am not a financial advisor. This is not financial advice. Do your own research, make your own decisions, but I'm here to support you. Okay guys, if you enjoyed this video, give me a thumbs up so the algorithm knows it's good. If you haven't already subscribed to my channel, consider subscribing. If you have any comments or questions, leave me one down below. I love hearing from you guys. Until the next video, take care.